Most people are playing the money game with the wrong rulebook. Think about a video game. At level 1, the enemies are small. The map is simple. You learn to move and survive. But if you take your level 1 character straight into the final boss fight, you die in 1 second flat. That is exactly what most people do with their money. They take advice built for someone with $50 million and try to apply it to their first 1,000. It fails every time. Not because they're doing it wrong, but because they're using the wrong map entirely. The rules of investing flip completely as you grow. What protects you at level 1 will actually cost you at level 3. And there is a specific trap waiting at level 3 that quietly destroys most families who finally start building real momentum. We'll get there, but first, let's find out which level you are actually on. Level 1, the survival map, 1K to 10K. 70% of people are right here with you, and here's the truth nobody says directly. At this stage, you are not an investor, you are a survivor. If you have $8,000 and you spend your energy hunting a stock that grows 10%, you make $800. That will not change your life. But a credit card charging you 25% interest, that will absolutely destroy it. No investment on earth consistently returns 25%. So, putting money into the market while carrying card debt means you are literally paying more than you are earning. The math works against you every single month. A teacher making $52,000 finally pays off their last credit card. That one move frees up $340 a month. They never got a raise. They just stopped bleeding. Your only job at level 1 is to build a cash shield. 3 to 6 months of living expenses, sitting in a boring savings account. Not invested, not risked. Just there, protecting you from falling backward the moment something breaks. Once that shield is built, the rules change instantly. If you leave all your money in cash during level 2, inflation silently eats it alive. So when do you move? And where does the money go? That brings us to the robot era. Level 2, the robot era, 10K to 100K. 20% of people reach this zone. Your shield is built. Your toxic debt is gone. Now your money needs to work while you sleep. But don't try to be clever here. Clever people get hurt at level 2. The most common mistake at this stage is picking individual stocks. You read a story about a hot company. You put $10,000 into it. The company dropped 40%. You just wiped out months of work. At level 2, you become a robot. You automate everything. An index fund is a basket that holds tiny pieces of hundreds of major companies. Grocery chains, tech giants, pharmaceutical labs, car makers. If one company fails, the others carry the weight. You are not betting on a single horse. You are betting on the entire race. You use a strategy called dollar cost averaging. Every month, the same amount moves automatically into the fund. When prices are high, you buy less. When prices are low, you buy more on sale. You never try to guess the right moment. Time beats timing. Every time. A warehouse supervisor never picked a single stock, just automated $400 a month for 9 years. They have $67,000 sitting in an index fund they barely check. As your pile approaches $100,000, a silent predator appears, a bill you cannot see, growing bigger every single year. Miss it, and the government becomes your largest expense. Here is what changes at level 3. Level 3, the tax shield, 100K to 1 million. 7% of the population ever reaches this map. You have real momentum now. But the bigger your pile grows, the bigger the annual tax bill attached to it. At level 2, taxes were a minor inconvenience. At level 3, they can strip tens of thousands of dollars away every single year, not from your income, but from your investment growth. This is where the location of your money matters as much as the amount. A regular investment account is an open field. Every time your investments grow, the tax man takes a bite. A tax-advantaged account, a Roth IRA, a 401k, an HSA, is a dome. Your money grows inside it completely untouched. No annual tax on the gains. The compounding accelerates because the pile is never interrupted. Charlie Munger, one of the most successful investors of the last century, built much of his thinking around this idea that eliminating unnecessary friction and cost at every stage compounds just as powerfully as finding the right investment. Taxes are friction. Eliminating them legally at this specific stage is one of the highest return moves available to a retail investor. A nurse earning $90,000 maxed their Roth IRA for 4 years. Their colleague in the same role, same salary, kept everything in a regular brokerage. The difference after 10 years? Over $40,000 just from the tax wrapper. Maximize every tax-advantaged account available to you before touching a regular brokerage. Plug every leak. Keep every dollar working inside the dome. Once you cross that $1 million mark, a legal threshold drops away, and what opens up on the other side changes the game entirely. Level 4, the closed doors. 1 million to 5 million. 2% of people reach this map. By law, once your net worth crosses $1 million, excluding your primary home, or your income exceeds $200,000 annually, the SEC classifies you as an accredited investor. That classification unlocks a category of investments that are legally off limits to everyone below this line. Private equity, real estate syndications, where you pool capital with other investors to buy a 300-unit apartment building. Early stage company stakes. These assets do not appear on any public app. They exist in private networks, in rooms most people never enter. A dentist hits $1.5 million net worth. Suddenly, they're getting invited into apartment syndication deals nobody ever mentioned before. Same guy, different number. When you had $5,000, nobody came after you. There was nothing to take. When you have $3 million, you become a target. One legal mistake, one bad accident, one unprotected asset can erase decades of work. So at level 4, you stop holding everything in your personal name. Corporate structures, insurance layers, cash flow assets that pay you monthly, rather than speculative positions you have to wait and hope on. You are not just building anymore, you are protecting a kingdom. But at this level, you are still mostly buying things that other people built. Level 5 is where that changes. Level 5, the engine builder, 5 million to 50 million. Top 0.5%. The everyday rules of personal finance are completely gone. At level 1, you were told all debt is dangerous. Cut up your cards. Pay off every loan. At level 5, that rule reverses entirely. Wealthy people at this stage do not sell investments to buy things. Selling triggers a massive tax bill. Instead, they walk into a bank, show $50 million of assets as collateral, and take out a low-interest loan against those assets. They use that borrowed capital to buy cash-flowing businesses and real estate outside public markets. They control assets far larger than their own cash pile. They never sell. They never trigger the tax event. They just keep the engine running. A real estate developer borrows $4 million against their portfolio at 5% interest. They buy a storage facility returning 14%. They never sold a single share, never paid a cent in capital gains. At level 5, you do not work for money. Your money doesn't just sit in index funds either. You own the infrastructure, the land, the private companies that supply the stores. Above this level, money stops being about lifestyle altogether. Level 6, the safe castle, 50 million plus. You no longer have a bank account. You have a family office, a dedicated team of professionals whose sole function is managing and protecting your family's wealth across generations. The goal here is not growth, it is preservation. $200 million at a 2% annual return generates $4 million per year. More than enough for a permanent, full lifestyle. Your biggest enemies now are estate taxes and family conflict dismantling what took generations to build. A founder sells their company for $80 million. 2 years later, they tell a close friend the hardest part wasn't building it. It was watching their kids grow up, never needing to fight for anything. So, you focus on generational structures, foundations, estate planning that carries the wealth forward intact, philanthropy that creates institutional legacy while managing tax exposure. You are no longer playing a financial game. You are writing a structure that outlives you. Find your level. Now you have the full map. 6 levels, 6 completely different rulebooks. Do not look at level 6 and feel overwhelmed. Find the level you are actually on right now and play that level correctly. Step 1. Strengthen the base. No cash shield yet? Stop looking at complex investments. Focus entirely on income, budget, and the emergency fund. That is the only game that matters right now. Step 2. Ignore the noise. When you see people online talking about private equity or leveraged buyouts, ask yourself if that tool fits your level. If it doesn't, tune it out. The strategy that wins at one level will actively hurt you at another. Fuel the engine. The levels only work if you have fuel to run the engine. And most people on levels 1 and 2 are leaking money in small, invisible ways without realizing it. If you want a specific, practical list of ways to free up extra cash every month to push your level forward faster, watch our video, 40 Tiny Habits That Will Save You Thousands.